Property Finance Uncut, the must-listen podcast for anyone with a mortgage. Find out the truth about what Australia's lenders are up to and how to make sure you're in the best possible position when it comes to your property finance.
G'day, hey guys, Phil Tarrant here. Welcome to Property Finance Uncut. I didn't expect it, but it happened. 25 basis points. The Reserve Bank of Australia has met literally a couple of hours ago, and they've decided to hike interest rates by 25 basis points. I didn't have it clued in. I don't think my guest, Paul Glossop, CEO of Finni Mortgages, thought it was going to happen as well. Paul, bit of a shock.
It certainly was, mate. It's probably only really one of the majors tipped it, and they were probably only one of, I think, about 50 or 60 panelists in the end, by the end of the month, that actually tipped a rate hike. And lo and behold, CBA got it right. You wonder what they might know that the average punter doesn't.
Well, you were chatting this morning, and we both had it as going, we think it's not going to happen, but there is a likelihood of one more. One more. Is it going to be this month, or is it going to be in a month into the future? CBA tipped it, but I think the CBA is also tipping this time next year we're going to be back to 2.85%.
That's exactly right, man. I think that's a really, really interesting observation. I think for anyone who's thinking, and you may be thinking the worst of the scenario here, the one bank that did tip interest rate hike prior to the actual rise coming through by CBA today, have had published, they expect by 2024 May to have the official rate at 2.85%. So essentially 1% less than what's the price point of actual cash sits as of May 2023.
Yeah, it's crazy stuff. It's who would have thought we'd be in this environment, but that's got to be a terminal rate. I can't see it going any further. And I say that interest rate announcements are normally a big day here at Momentum across a lot of our financial services brands. I was only just on the phone. I actually have a chat in the office with my colleague, Charbel Kadib. He's one of our senior journalists writing across all of the sort of financial advice wealth sector for people that work in that space, brands like Money Management and Investor Daily and IFA and all that sort of stuff. He told me he just got off the phone to Shane Oliver, who is the chief economist from AMP Capital. So most people will probably be familiar with Shane and his commentary. And I said, what did you guys talk about? And he just shot me through the quotes from Shane. And Shane can, he's a very well-respected economist. I've had him on this podcast beforehand. I'll read out some of the quotes, Paul, to give some sense to how he sees it. He said, I think the main concern is the RBA has gone too far and unnecessarily going to plunge us into a recession. Yes, inflation is too high, but there is upside risk to wages growth. But by the same token, there's been tightening in the pipeline yet to fully feed through to the economy, and that's going to cause a lot of pain this year, particularly for households with a mortgage. So I don't think they're allowing enough time to let lags or the lag impact of past hikes show up. We've spoken about that before many times on this podcast, particularly over the Christmas period, saying, hey, it gives them a couple of months to actually work out whether or not it's made any impact. And he continues, since the last meeting, we haven't yet got an update on retail sales. The Reserve Bank indicated they wanted to assess the state of the global economy, labour market, inflation, and retail sales. But we haven't got an update on retail sales over that period, and the inflation numbers we saw were actually better. So, Paulie says, in terms of whether the cash rate has peaked or not, we would think it probably has, but the risks are still well and truly on the upside. In fact, you could argue that the tightening bias was actually strengthened. Previously said that further tightening monetary policy may well be required. Now they're just saying may be required. So they're changing the rhetoric. So I must admit, says Shane Oliver to my colleague Charbel Kadib, that is a bit of a surprise. I would have thought the main argument for a pause a month ago was to provide more time to assess the lagged impact of past rate hikes and better assess the outlook. They would look at certain indicators, the global economy, inflation, jobs markets, household spending, etc. So he sort of summarizes at the end of it, I'm a little bit concerned that they're probably getting too hawkish or moved too quickly, is how he's concluded.
And mate, I think that the two biggest things that we've talked about over the last probably 6 months in particular is, the unemployment rate still sitting at about 3.5%, which that information only came out last week, and I'm assuming the RBA really took that into consideration because that obviously the tighter the actual market that sits there, probably more pressure on upwards on wage growth. But we've seen nothing but positive news coming out of the international migration data. And the reality is we've got another 200,000 people coming to Australia this year and another 350,000 slated to immigrate to Australia next year, skilled workers, which in turn will no doubt put more pressure on, or upward pressure on, that unemployment rate, which, going back to Shane Oliver's comments, you're talking about needs time. It needs time to filter through, not let alone this 800,000 odd borrowers who are coming off fixed rates into variable rates this year, which the bulk of that still hasn't actually happened. So you and I, we've talked about this, that I was very surprised that it's happened today. Now, is this a 1%, 2% increase? No, it's 0.25%. So the reality, what does that mean? You're talking the difference of a few $100s per month, which is no small change when you talk about after-tax money. But it's still going to be another nail in the coffin for a lot of people that think, well, this is just getting a little bit too hard. So it's going to be interesting.
So what's the mathematics then? For every $100,000 in debt, you're paying another $2,500 in interest. Is that correct?
Yeah, give or take.
A
year. Yeah. So I mean, the reality for this, when we sort of when we look at it across the board,
that's every million, but
every million. So every million. So
every million is another $2,500 a
correct. So this is a $1,250 increase for a $500,000 debt for anyone who's got a variable rate right now or is fixed going over to variable. That's what this means. But obviously this is now 11 rate hikes over a period of a year, which obviously is very, very detrimental for any of those people who are redlining it. I think what this speaks to, probably more importantly now, though, is anyone who's sort of thinking, well, what do I do? Because I think what is positive, and if we take the positives out of this, is that, to your point a bit earlier, Phil, I think we're at this terminal rate now. And for anyone who's not really familiar with what that is actually going to mean, it means the reality is the only way from here is likely to be sideways and then eventually down, because what I spoke about very early in this podcast was that CBA were the only ones who tipped this interest rate rise, and they're also the ones who are actually saying that they expect the cash rate to be 2.85% within 12 months' time. Now, effectively, that's 4 rate cuts of 0.25% between now and this time next year. So we start to think, well, if every 1% of cash rate changes into the economy moves property prices by approximately 10%, you start to do your math on where that's going to go now. Now, if CBA have got their math right, you've got to start putting that into perspective. And anyone who's thinking about fixed versus variable loans right now probably needs to start considering, is that rate that they're getting on fixed going to be a fair bit sharper than what the retail variable rate is now, because the mail is rates are going to go down.
And that's the question for your mortgage broker, no doubt.
100%. And I think that's where strategy and tactics come into play, with cash flow overlaid, as well as, do you need to have some security in the fixed, or is there better value in going to a variable scenario for a 12-month period of time? And also potentially considering, is there ways to extract equity, etc. But that's exactly what we're doing at Finni right now, is having those discussions. They're very important ones at that.
Yeah. So if you haven't yet looked to refinance, or the opportunity to refinance your loans, if you haven't done that over this, is it 11 or 12 consecutive rate? 11?
Well, it's 11 consecutive rate hikes over 12 months.
Over 12 months. 11, because we didn't meet in February, the Reserve Bank.
Correct.
So if you haven't done that yet, I'd definitely be looking at it now.
Yeah, absolutely. And we're probably now, the fact that, if anyone can take some confidence out of this decision, it's probably saying, hey, they had one more swing, and they've taken that swing now. So that swing has happened, and you kind of know now that there's no more bullets left in the
you'd
chamber.
Think so, right? Yeah.
You'd think so. I mean, the reality, this was either a pause month and then reassess for a couple of months, or this was, hey, let's go a bit harder, a bit earlier. Which is kind of consistent to what they've done. It does question why they paused last month, when there's not really any dramatic data that we've seen that probably should affect it. But anyway, that's obviously not our wheelhouse. But I think anyone who's thinking, well, where to from here? I think where to from here is sideways, then likely to be down. If you're looking at the money markets, looking at the big 4 bank economists and everything else that's sitting around out there, it looks very likely that we're now going to go we're at the terminal rate, and we're going to enter into a sideways then reduction in rate prices.
So what you can't control is what the Reserve Bank's going to do, and we're going to know exactly where their headspace is once the minutes come out shortly. What you can do is make sure you've got the right mortgage for yourself and whether it suits your particular purposes, your strategy, your goals. Now, this is running in parallel with slight upwards increases in property markets in Sydney. Whether that's going to slow it down or whether it's going to give confidence in the market. Let's see what happens at auction clearance rates this coming weekend, because that will give a sense for what Australians think around whether there's any more rate rises coming or that's the extent of it. But speak to your mortgage broker, speak to the team at Finni Mortgages, finni.com.au by memory is the website. If you've got any questions at all, whether or not the rate's right for you, whether you should start thinking about fixing, whether you should stay variable, all that good stuff, all that good gear, they can cover all that stuff, can they?
Absolutely, mate. And that is the crux of it here, is that speak to your mortgage broker. If you haven't done so, it's so important now to, even if you do have a fixed rate that you're comfortable with for a period of time, or you're already set on a variable rate and you're sort of just thinking, okay, well, I'll set it, let it be there and let it do its thing. If you haven't already spoken to an investment savvy mortgage broker, do so, because have that conversation to set that plan. And that plan should be reassessed every 12 months. And if you're not having it, start having it and start putting it into your diary to say annually, you should be having that conversation. In the last 12 months in particular, probably should be having that conversation with your broker quarterly. Sometimes it's a 5-minute catch up. Other times it's a more detailed conversation about saying, hey, there's some big structural changes. But yeah, as you said, mate, there's over 70% of loans written by brokers, and it's for good reason, is that they're the ones out there doing the heavy lifting, providing the strategy and providing a huge amount of different products. So speak to your broker. Don't sit back and let it happen to you. Dictate terms yourself.
Yeah, and you got to be prepared to do the work if you're going to do that. I highly recommend the juice is worth the squeeze, and I doubt if you go to your mortgage broker, they won't be able to find something more appropriate to what you've got.
Completely.
Right now.
Completely.
That's just, it's always the way it is.
Absolutely.
That's what good brokers do. That's Paul Glossop, he's the CEO of Finni Mortgages. Paul, what's the website again?
Finni.com.au, finni.com.au.
Yeah. And people can book an appointment or something. They can
straight on there, mate. The first front and center button there will get you straight in touch with one of our senior brokers immediately.
All right, good work. Thanks for your time. Remember to check out smartpropertyinvestment.com.au. A lot more rate coverage coming. I think this is it. I think that's terminal rate. So you can move ahead with some sense of continuity, make your plans around it, work on the family budget, minimize your spending, maximize your savings, get ready to buy, hopefully, and keep investing in property. For Tarrant, I'm managing editor of real estate here at Momentum Media. Thanks for joining us. See you next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.